Today, I'm going to start with an overview of what's been going on in the markets. Obviously, we have a new chairman of the Fed that we heard from for the first time last week. Talk a little bit about those implications, talk about some of the opportunities we're seeing within the fixed income marketplace, and most importantly, how the portfolios are positioned to try to generate the income and total returns that we're trying to look for in the market in the forthcoming year. And so, starting off, I want to start with kind of where we are in the Fed cycle today. As I mentioned, there's a new Fed chairperson there. And what we heard from Chairman Warsh was that we're going to get a lot of task force associated with redefining and reshaping some of the behaviors and policies at the Fed. And so, as we wait for the chairman to unveil those task forces and essentially the conclusions of what they find, we go back to our kind of old friend, thinking about the where the Fed funds is, but also our old friend, the markets, and how they're pricing the Fed regime. And I think it's good to take a tour back through history because what we see here is if you look at what we have on the slide, this light blue line, it shows what the Fed funds rate is. So this is the target policy. It's the effective rate, so it moves a little bit around that target policy and what the market is priced in 12 months into the future. And I think it's very interesting to see that back in the early 2000s, what you found was that the market pretty much kind of nailed where the Fed policy ended up, right? It was roughly at 5.5%. Um, the market didn't really fight that. And the market started to signal ahead of time that potentially the Fed's on a cutting regime. Then we saw post GFC the idea that, or during the GFC, the idea that the Fed's going to need to hike. The Fed kind of moved up a little bit. They had to cut massively as we got a deepening of the GFC. But notice there, what you see, the relationship post GFC until really around the pandemic was that the market essentially was always pricing the Fed to be on a hiking campaign. Or said differently, the market was always expecting interest rates to be higher than where Fed policy currently was. And then again, coming into like 2019, we're seeing some signs of slowdown. The market started to get more in line with what the Fed is, started to price in some of these cuts. And then effectively, as things were slowing down into early 2020, the market was really ahead of this. Notice again, too, when you look at late 21, the market started pricing in the Fed hikes prior to the Fed actually executing on that. And I want everyone to focus on that part up until 22 because the market was really a good signal of leading what the Fed's behavior was. That is, the market was kind of in tune with where policy was going, or potentially said a different way, like our fearless leader Jeffrey Gundlach likes to say, the two-year Treasury leading the Fed. But notice what happened once we got to peak of the last hiking cycle. I recall that press conference back in September of 23 when Chairman Powell said, we've probably seen the last hike in a cycle. The tightening regime is over. And notice that the market heard that as a cutting regime is almost imminent. And notice those kind of head fakes we've seen with that black line. Although by the second hump in that black line in late 23, or I'll call it early 24, you started to see that kind of pricing where the Fed got a year prior. Notice that the market's been really leaning into these Fed cuts and kind of trying to force the Fed's hand a lot more than policy ever materialized. Now, all of a sudden, we've seen the market recalibrate and drive the other direction today. And now the market's expecting over the next 12 months, somewhere between 2 to 3 25 basis point hikes. And I think this is important because one thing the new Fed chair has talked about prior to taking on the role that he has today was that he does not like forward guidance. If you notice the Fed statements, they did not have much in them. They were just saying, we will fight inflation. Chairman Warsh said, we will fight inflation. We will fight inflation. We will bring it under control. And so Chairman Warsh is really spending, this first period saying, we will attack this. And I think the bond market, rightfully so, said, well, maybe in order to do so, you may need some rate hikes into that market. And so I think that's important because also with the chairman saying that there's potentially reduced communication coming forward, that is a lack of forward guidance, a lack of dot plots, a lot of signaling, potentially, fewer conversations or fewer speeches from Fed governors, or kind of restricting the Fed governors from kind of revealing kind of their inner thoughts about where they think policy should be, then potentially we need to use more signals from the market on the direction of Fed policy. And so, in general, when I look at this chart too, it seems that something has changed a bit in the psyche of the bond market. This is the first time since we had the end of the hiking regime that essentially the rates market has said policy needs to be tighter, or policy within a year's time will be tighter than it is today. And that is something that's kind of flipped in the psyche of markets right now. I think it's something to really pay attention to over the forthcoming months as we learn more about the Fed chairman, his policies, his task force, and ultimately what that means for the overall marketplace. But if you look at what's happened in the rates market, what I see in these charts is I see a tale of somewhat, I'll call them three markets. Let's look at the 2-year Treasury and the 5-year Treasury yield. If you look at where we entered 2026 into, so you kind of look right before that January hash mark, what you see is the 2-year Treasury was near the low. In fact, the low of the cycle for the 2-year Treasury was the day before the invasion of Iran this year. And so when you look at the 2-year Treasury, it was pricing a lot of those cuts in the marketplace. Obviously, there's been a repricing since then. The 5-year Treasury, again, not at cycle lows, since we've had this hiking regime, but very near the lows of that. So I think the twos and the fives were telling you something about potential Fed cuts, maybe a little bit slower growth regime in terms of nominal growth. And that's how those markets were pricing. Obviously, things have really repriced over the last 4 months since some of these new inflationary pressures have come from both food and energy, but also just that core inflation has not really subsided, especially as much as the Fed would like. But you look at the 10-year Treasury, and we go back to coming into 2026, and if you look at this time period we're looking at since the beginning of 23, you see that essentially the 10-year Treasury was in the middle of its trading range. So yes, it was kind of in a local low, but definitely more in the middle of that overall trading range. So there's a little bit of difference of how the market is trading different parts of the curve. And then lastly, when you look at the long bond or the 30-year Treasury, what you see here is that essentially we were almost near one of the highs of the cycle, or at least the upper end of that trading range. And so what you see is that all these relationships have changed in some capacity, but you still have the long bond still being near its cycle highs. Yet the 10-year Treasury now more of an upper part of that trading range. And ultimately, the twos and fives have kind of moderated into this middle of the range. And so, if I think about the current inflationary environment, and yes, there is potential relief, whether we get a deal in Iran, it's on again, off again. It's very difficult to understand what's coming out of Washington, these policies, and the negotiation from the other side, from Tehran as well. But in general, it seems that the market is selling this idea that potentially we have a little bit higher inflation. Potentially that needs to get priced along the curve. And ultimately, there's still some of this fear on the back end of the bond markets in general. And for those of you that follow a lot of our chart work, what we show is that this 30-year Treasury yield is not just a U.S. phenomenon as well. This trading range and being these upper end of ranges is something that's very endemic within the entire developed sovereign world. These longer dated treasuries, these longer dated sovereign risk out there, 30 plus years, tend to be trading much more poorly, whether that's in the UK, which has one of the highest developed market yields. We look at things like Australia. We look at the even if you look at the French bond market, German bonds. We go out to the JGBs in the Japanese market. You're seeing that it's a similar kind of rejection of wanting to own longer duration risk. And this is something the team here at DoubleLine has been talking about for many periods of time, for a prolonged period of time. But also, more importantly, it says that there is some difference in the world. If you looked at these charts prior to the pandemic, what you see is there was an insatiable demand for longer dated assets, higher interest rate sensitivity assets, and that seems to be changing in the developed world. And so, when relationships start to change, investors need to really kind of recalibrate and think about why that is and what the underlying reason is. And I think that all signs of that point to the fiscal largesse that exists within the developed economies. And so let's look at the scoreboard too. That's my one macro chart that Jeff said we were going to talk about. That's my one kind of rates chart. I'm going to talk a lot about yields and trying to generate income in today's environment. I know there's a couple questions in the queue already about income and distributions. And at the end of the day, I'll explain why we have some return of capital in the portfolios today. But what we're trying to do is have prudent risk management. And so if you look at the environment so far year to date, and this goes through, I believe, last Friday through June, or it's last Thursday since we had the holiday on Friday. So it's through the end of last week. But you can see here that bond yield, sorry, parts of the fixed income market had given you somewhat paltry returns. In some cases, they're near flat. As the best performing sector seems to be emerging market sovereign debt at a whole 3%. But you can see here that there's been some consistency that a little bit of the lower quality asset tends to be doing a little bit better. Floating rates outperform fixed rate. You can see that because of what I showed on the yields chart too, with yields going up. That's had some negative mark-to-market losses on that. But in general, it's been a broad smattering across the various markets. So if you're a fixed income investor today and on a year-to-date basis, you've been doing about 1.5%. It seems that you're keeping in the middle of the fairway. Really, the big loser here that you see on the chart is actually the triple C loan market. And we've been talking about the risk within the loan market, a lot of this triple C debt, and I'll show you when we talk about yields on this side. There's a lot of landmines out there and a lot of idiosyncratic risk, and still some of that is still leading to kind of what we see in the BDC private credit world of being very exposed to these kind of more telecom software type names as well. So let's do a review as a high quality investor. What are your offerings today? And so if as an investor, one wants to stick in the investment grade universe and you want to take various parts of the investment grade universe, what's being offered on the market today is somewhere between about roughly, call it 4.5% to about 6%, right? And so when we talk about closed-end mutual funds, these are things that generate 8, 9, 10% type of yields out there. It's very difficult to do in an investment grade portfolio. In fact, in general, it's almost near impossible to do given the limits of leverage. If you want to use an investment grade triple B portfolio and lever it one time, when you lever, you have to pay a borrowing rate. That borrowing rate's related to SOFR. That borrow is probably going to cost you something like 4.25 to 4.5%. So even if you lever that up, you get 5.4 minus 4.5, you get an extra 0.9%. That gets you all the way to 6.3%. So there's not a lot of room in here. And remember, you would double down on your risk by doing so. So there's not a lot of room in the investment grade world to be able to maneuver today to get something north of 6%. And there's reasons for this. If you think about the resilience of the U.S. economy, we think about just the prudence of corporate America in the investment grade side, how well they've done in restructuring the debt, the cash flow generation in the U.S. I mean, there's reasons that spreads and all-in yields trade at the levels they do today. Not shockingly, that tends to be correlated when stock market multiples trade at relatively elevated values as well. So when you look across the overall spectrum, it's very difficult to go out there and find any sector of the investment grade market that actually can get you something north of 6%. So again, remember, we're takers of what markets give us. When you try to force trades, you can lead yourself into causing more risk than you want in your portfolio. So obviously with closed-end funds, we can be much more patient. We don't need to provide intraday or daily liquidity to investors. And so it allows us to take longer views on things. And so again, you'll see that we tend to use a lot more of the below investment grade securities. But when I look at this chart and across the spectrum, I see 5 bars on here that have a yield north of 10%. So as an investor to go out and earn 10%, and again, without introducing leverage into a structure, what you have to buy is either purely triple C, high yield risk, or a very lowly marginalized single B minus risk that's probably much more akin to triple C and hasn't been downgraded yet. You can buy triple C bank loans, right? You can buy these triple B minus CMBS conduit deals. These are essentially very seasoned, they're not very seasoned, but they're seasoned deals that have a lot of office exposure. I think most of us in the market participants would agree this is not truly triple B risk, even though the rating says that. We think of it at DoubleLine as much more like triple C risk. So I'd say those are somewhat akin. It's probably low single B to triple C risk. You can buy double B CLOs. Double B CLOs are essentially highly exposed to that lower end of the leverage loan market, or you can buy triple C. Yeah. So when I hear people talk to me and say, "Well, spreads are tight," the market is just turning a blind eye on credit risk. No, there is a discerning view in the credit markets. If you look at this and you look at what's happening in the triple C market, the market is saying these are risky parts out there. So again, from a prudent standpoint and where we are in the economic cycle, even though I think the U.S. economy is firing quite well today, we're in the middle of a capex boom. We have a big technological revolution going on right now. We have a labor market that's holding up. We seem to see a resilience of the aggregate consumer. I know there's lots of stress on the lower end. And what you find out there is that it's very difficult to want to take these highly exposed idiosyncratic bets. So what this allows you to what this leaves you with in the opportunity set is things that offer you 6, 7, 8% type of yields today. And by the way, a lot of those 8% yields, they get very difficult to source a lot of that paper where you don't take a lot of idiosyncratic risk out there that looks like it's either it's going to pay off or you're going to have a default. So from that standpoint, when thinking about the investment philosophy within our closed-end funds, the idea is to create diversified sources of the yield and the income across various sectors of the market, also while keeping a keen eye on the risk. And so I showed you yields those areas. That's a snapshot as of the end of the month. And so, or I'm sorry, that's a snapshot at the end of Thursday. But if you look here on this fixed income yields, what this also does, it takes the current yield. And so the current yield is that triangle on there. So you can see where the market's pricing that risk today. It compares it to what over the last 10 years, the average yield of this area is, and that's that blue box. So you can see in most cases, current yields are above the average. Remember, when I'm looking over a 10-year period, we were mired in low rates back in 2020, 2021. So that has part of it. But also look at the wide band, the range, the black bar, that's the min and the max across those time periods. And so you can see there that yields tend to be in the middle to kind of upper half of the overall trading ranges across the board. A lot of that has to do with base rates or treasury rates out there. But in general, there is the ability to generate income in today's market. And so that's what the team here at DoubleLine has been focused on across these products. I talked about spreads. And if you look at what we see here over the last few years, what you find is that I look at the spreads right now, and they're at really kind of cycle tights. So I show this chart just to show that, again, people say, well, spreads are tight. Why would I invest today? Well, outside of these couple of spikes we saw, the spike that we saw in March and April of 2025, well, yes, spreads widened because we were hit by a tariff policy that looked like it was almost a global depression and what it was going to impose on the global economy. So that spiked very briefly and came back down. Then we saw, with some of the pressure we've seen from energy prices with the Iranian conflict, what you see is that we saw some widening of spreads, but it's been very well contained. All these episodes of spread widening have been matched really in the same kind of magnitude of rise. And I bring this up because when we talk about tight spreads, in order for spreads to not be tight, you need a catalyst. So for us to get off this bottom or this tightness in spreads, there needs to be disruption to either global orthodoxy. I guess you could say we've been trying to do that, for the last year and a half or so. But also you need to have something change fundamentally. And right now, that's not what's happening. And so unfortunately, we're probably stuck in one of these trade ranges on spreads for a while. I like to remind folks spreads can stay tight for very long periods of time. They've done this in the past. I encourage everyone to go back and look at the slide of 2003 until 2006. The chart will look very similar to this. The trade ranges get very narrow over prolonged periods of time, and that's what happens when you're having economic good times. Now, I know you could challenge that and say, well, we have high inflation levels, we have low sentiment. There's a lot of that's there. But in general, remember, we have to, as market participants, focus on the aggregate. And that's what continues to perform and has shown extreme resilience in the face of a lot of things that we've thrown at it over the last few years. One thing that has come under pressure in the last couple of years is the dollar. This is what we call the real effective exchange rate, or RRER, on the dollar. And what this does is this essentially takes the average and it takes standard deviation bands and tells you if we're cheap or rich. And notice here that the dollar's been rich for a long period of time. Again, we've seen a little bit of bounce in the dollar versus the developed world as of late, just because of some of that repricing we've seen post-Fed as well. But in general, the dollar still looks very rich. And I think that's important because as we think about, kind of the implications going forward in investing, one of our theses is that investors should really start to look at diversifying outside of the US dollar as well. And our favorite place to do that is the emerging market world. And if you look at this chart that we have here, we use two things. One is the dollar spot index. It's roughly what I was looking at on the previous one. There's some slight nuance there, but that's that light blue line. And then we take the emerging market local currency index and divide that by the US corporate index. And so by looking at that, you're trying to get kind of a risk premium there. You're saying, okay, it's essentially related to effectively both the increased carry you would get from local currency, that is the higher yield you get, but also some of the currency fluctuation, well, because you're taking that currency risk. And you can see as these lines, they're somewhat correlated. They're not perfectly correlated, of course, but this is something that if you expect some weakness in the dollar, probably the best place to play that is local currency emerging markets. And that's something that we've introduced in the closed-end funds over the last year or so. So that's why I wanted to bring that up. On page 19, shows the rankings of where we are in the last 10 years in percentile rankings in terms of spread. So when I showed the other chart that had the box and whiskers that had the min and maxes on it, that was done in terms of yield. This is outright spread. So this is the incremental risk you get for entering these type of positions. So on the horizontal axis is the spread today. But if you look at the vertical axis, that says the percentile ranking. So the higher the percentile ranking, so when you see like bank loans at 60%, that says that the bank loan spread today is higher than 60% of the other observations. So bank loans tend to be one of the cheaper parts of the market. Some of that, since this is index data, I would say a lot of that's actually being driven by that triple C cohort because of the incremental risk there being around 10% or so of the bank loan market. That's driving that. And there is some weakness in software as we've seen throughout the year. The software makes up about 14, 15% of the overall bank loan market out there. So there's a little bit of that stress there too. But notice even the triple B CMBS that we'd said have a lot of risk in them. Notice that they're almost at the median point. So what you've seen at this part of the cycle is the first thing that got to their tighter levels or their lowest kind of percentile rankings are the things that are heavily trafficked in, that are the largest ETFs out there, largest sector exposures, IG corporates, emerging market debt, high yield corporates, and obviously the ad. Those are the tightest areas of the market. We don't have Treasury on here because by definition they have no spread. But if you look at the other parts of the securitized market, although they're getting richer, they're finally catching up to kind of that valuation of what the other markets are. So from that standpoint, they still look cheaper than the others. They're not cheap by historical standards of being, that roughly only 25 or 35% time they've been having lower spread than we see today. But if you think about the economic environment that's a good context for thinking about the tightness of spreads as well. So from our standpoint, we still favor a lot of the securitized market. And I'll go through that on these funds. The other thing that we like is the emerging market space as well. So let's start with a recap of the funds. Here, what we've done since the inception of the funds, the positioning today. We'll talk a little about leverage and credit quality, and then we'll open up to questions. So I'm trying to get this one a little bit dialed down in efficiency. And if there are any more questions, feel free to submit them now. So if you look at the performance of the opposite income closed-end fund, opposite credit, sorry about that, opposite credit, DBL, closed-end fund, what you see is three lines from the chart. The light blue line is the NAV. So remember that closed-end funds trade on price, not always the NAV. NAV is the thing that we control. As investors, the price is how you trade in and out of them around the NAV of the fund, kind of similar to ETF, but they can be dislocated for longer periods of time. If you look at what you see here on that light blue line, you can see that we've generated about a 5.6% annualized return with about 4.8% volatility, which gives you a Sharpe ratio of 0.83. Comparing that to the aggregate 197, as Jeff pointed out at the beginning, 370 basis points per annum on NAV over the index, and about 8 times the Sharpe ratio. However, if you calculate some price because of the fluctuations, the premium discounts that come into this, notice the volatility spikes 3x, and your return has been a little bit lower because of a little bit of that discount to NAV today as well. But again, either way you look at it, you can still see roughly 300 basis points of outperformance, even on a price basis. Obviously, Sharpe ratio goes a lot lower because that daily mark to market because of the premium and discount. What do we do in DBL? DBL was launched back in January 2012. It was launched to be a mortgage-centric fund. So by prospectus, we need to carry at least half of the portfolio mortgages today. So again, we can introduce leverage into the structure if we like. You can see there on the fourth line on the left-hand side says gross leverage. We have a 6.7% leverage ratio today, which is low by all standards. And a lot of that's because when we go out and find opportunities in this market, although the portfolio, we can find 8% yield with this focus on mortgage-backed securities, it's hard to get securities that earn meaningfully above the borrowing costs to be able to lever up without incurring significant risk. And so remember, we don't just look at income. The idea is not just income because you need reliable income. You need income that you believe you're going to earn. You don't want to get defaults. You don't want to lose money along the way. And so from the standpoint of how tight spreads have got, specifically where we need to have a lot of the portfolio, it's had us bring our leverage ratios down as well. Again, this is just the DoubleLine way of investing, of thinking about how we're thinking about allocating from a risk-adjusted return standpoint. If you look on the right-hand side, you can see here the mortgages. We have agency mortgages almost 17%, non-government guaranteed residential mortgages at 22%. So your residential mortgage exposure is about 40% of the fund. You bring in commercial real estate, commercial mortgages, another 25% of the fund, and then we round out the rest of the portfolio with some floating rate loans through bank loans and CLOs, roughly almost 30% of the fund. There's a little bit of high yield and EM corporates in there as well. So from the standpoint of looking at the overall portfolio, this is a heavily mortgage-backed securities fund. If you look at the ratings distribution at the bottom, you see that roughly about 41% is below investment grade, about 8's unrated. Of those unrated, I would say the bulk of those would be comparable to be below investment grade, maybe about 6%. So call it about a 45% below investment grade, 55% investment grade portfolio. So again, this is the longer track record we have out there, tends to be more mortgage centric. I mentioned leverage. What you want to do with leverage is that leverage when things are cheap, you want to be able to access your leverage lines. You want to go buy cheap assets when things get rich. You typically don't like to lever up as much. At least that's the DoubleLine philosophy. And you can see over the last 10 years, we are near the lowest level of leverage that we've experienced on a month-end basis within the fund. And again, it's a function of opportunity set. When we find assets that we like, we buy a bit more. You can see that there was a little bit of a buying spree later last year where we started buying a little bit more on the commercial mortgage side. And you can see that kind of vacillated between, let's call it 5 and 10%. And again, this is from a standpoint of what we believe to be prudent risk management in today's market. If you look at the credit quality of the fund, we just kind of gap these into the government agencies. That's the black and the light blue at the very bottom. You can see that we had a lot more agency mortgages when the basis was out there, was the ability to generate a lot of that return out there. We were using both parts of those market. Most of our government securities you see here are actually government-backed mortgages. Again, it's just the difference between Ginnie Mae's. You can kind of think of that as being Ginnie Mae. The agencies are more Fannie and Freddie. But you can see there that there was that bias there. But as the credit markets have become more attractive, we had much more into those markets as well. Notice the below investment grade bucket has been pretty stable over time. There's been periods where we've had more unrated and a little less below investment grade, kind of bouncing back and forth. But in general, the credit quality of this remains pretty resilient and pretty close to how we've managed it throughout the entire 14 plus year history. And so I know investors say, well, it yields 8. How come you get 5? Well, you have to remember there's been a lot of repricing in bond markets over the years. And still, if you compare this to an index fund, you've been generating on a price basis 300 basis points per annum incremental return relative over 14 years. That's a lot of compounding of excess return to deliver in the closed end structure. So with that, let me move on to DSL. DSL was a fund we launched right before the taper tantrum. I launched in March of 2013. I'm sorry, I launched at the end of April of 2013. I'm still shell shocked by May of 2013 when the taper tantrum started, thanks to Ben Bernanke. But here, notice that the middle column, we've done a return of 4.29% on an NAV basis with a 6 vol. So that gives us a Sharpe ratio of 0.43. And if you look at the global ag, it's actually underperformed cash flow this period, hence the Sharpe ratio is NA, and negative Sharpe ratios don't make sense. You should never do a negative Sharpe ratio trade if you do that a priori. But notice that 0.63 is what the global ag has delivered over this period. So we've had slightly higher volatility than the global aggregate, which this one's benchmark against. It's benchmarks against the global aggregate because when we came out, the idea was to capitalize on the emerging market trade, the non-dollar trade, potentially through the cycle. And that's been the lifeblood of this overall fund. That's had a bias that direction, so hence the global ag. But notice again, you're talking about 360 basis points of excess return per annum. And this history goes back a little over 13 years now as well. So yes, the price return slightly lower because of it trading at a discount today. But notice the volatility is roughly about 3 times what the NAV volatility is. So, people ask me about private credit or BDCs versus this. When you talk about these private credit funds that have very low vol at the price level, maybe the assets move around a lot more. What you see in closed-end funds is the opposite. The NAV volatility, or what the actual assets are priced at every single day as a volatility, but because of that premium discount volatility, it adds more vol throughout the overall life of the fund. So kind of weird that some people like to see the more vol because it creates trading opportunity. Some people want to cover it up. But at the end of the day, the NAV is the NAV. How is DSL positioned today? I mentioned that we started off as more of an international type fund with a bias towards emerging markets. Notice here that this portfolio yields almost 10% today. It is on the leverage basis. We do have 21% leverage in this structure. And the reason for that is that we have a much broader mandate here. And because of our income targets that we're doing, we're able to, we want to use a little bit more leverage in here. Notice, again, there's very few mortgages in here in the agency or the government backside. We do have some non-agency mortgages, not very many, only 2% here. And again, when you look at the yield opportunities today, and the reason we're able to generate more yield in this product is because of the focus on EM and the below investment grade credit sectors of the U.S. corporate market. So you can see north of 20% in both high yield as well as bank loans here. Not a lot of exposure to triple C. We're allowed to have up to, I think it's 20% of the portfolio in triple C, and we're below even half that today. So the idea, even though there is this yield in here, some of it, the incremental yield comes from leverage. Some of it also comes from investing outside the U.S. So if you took the EM exposure plus the EM local exposure, roughly about 35% of the fund as of the end of May. You can see this is a much riskier portfolio from a credit standpoint. About 3/4 of it is below investment grade. And if you add the unrateds in there, it's about 80% of the overall fund. So again, this one has much more, a little bit more risk in it. Today, it definitely has much more from a credit risk standpoint. But as you kind of notice over those periods, although they're not exactly the same time period, it really hasn't incrementally moved the volatility up on the NAV basis in a meaningful manner. I mentioned leverage on DBL. So even though we have about a 21% leverage ratio today, if you take a look at what you see on the screen your last 10 years, very consistent pattern what I showed with DBL. We're trying to risk manage this. We want to minimize the amount of leverage we're using today. We're only using it when we really find those good opportunities out there. And so this is a place we've been roughly for the last 3 years. Remember, leverage got expensive. When the Fed's hiking, where leverage ratio or the leverage cost is correlated to SOFR, which is correlated to the Fed fund policy rate. And so when those costs went up too, it made borrowing much more expensive. Today, now we have tight spreads, borrowing's moderated, and potentially we're in a world of Fed hikes as well. So if that's the case, again, remember leverage cuts both ways, and it does have costs associated with it. And it's just not in our DNA to want to be levering up portfolios in a significant manner when we have spreads in a lot of these asset classes, trading in some of the tightest ranges we've seen or tightest levels we've seen in the last decade. So again, the credit quality here, this tends to be a much more below investment grade fund. We've introduced more investment grade risk since the pandemic as yields got better in some of those markets. But at the end of it, we're really focused on it is a below investment grade quality portfolio. There's a question about the percentage of international investments. It's about 35% of this overall fund, which was 2 slides ago. So let's finish out with yield opportunities. Dilly, as we call it around the office, DLY. So you can see Dilly, unfortunately, launched right before the pandemic. Had a little rough time out of the gate, as everybody did in that vacuum of liquidity. But what you see here is that blue line, again, is the NAV. The more choppier gray line is the price, but that dark blue line is the Bloomberg aggregate. So let's focus on the middle column once again. 4% return since per annum since the inception, where the U.S. aggregate gave you 43 basis points. So 360 basis points per annum. So notice each of these 3 closed-end funds, since their inception, had really between 300 to 400 basis points, let's call it 350 to 450 basis points of excess return per annum versus the bond market. So again, I know it's been tough sledding out there, but in general, you're only a function of what the market can give you. And notice also during this period that Dilly, on an NAV basis, the volatility has been about 80% of what you see in the Bloomberg US aggregate. Risk, this does have leverage on it, which I'll show you. But again, it had a tough time at the very beginning, given the vacuum of what we saw during the pandemic. And look at the portfolio, very similar to it kind of sits between DSL and DBL. So you saw DBL at a yield of around 8. This one has a yield of about 9. DSL is a little closer to 10. But notice this one's much more diversified and much more US centric. So the difference here in this portfolio, it's much more diversified across the various credit sectors of the US markets. Yes, we still have EMD. We have some of that EM local, the EM exposure about 15, loans at 17, non-agency mortgage by 18.5, 19 in CMBS, 19 in high yield. Our CLO exposure is a little dialed down because of our bank loan risk in here, about 8% there. And we have some small pieces and a couple of kind of off the run ABS issues as well. This portfolio, even with all that high yield of loans in there, doesn't have as much below investment grade. But when you add the unrated in there, it tends to be a little bit lower. There's a question about opportunities unrated. Do they have attractive yields? And the answer is yes. Otherwise, they would not be in the portfolio. Some of these unrated securities are because they're kind of like lower end of securitization tranches. So they're mezzanine type things that don't get ratings. Some of them also they don't get ratings from the rating agencies, and thus they're unrated. The bulk of these unrated would be equivalent to a below investment grade rating today. Unlike if you look at our open-ended funds, when you see our open-ended mutual funds or ETFs out there, when you see unrated, most of those are more on par with investment grade rated. But again, these are meant to take credit risk. These are riskier portfolios than we run in the open-ended structure. And the idea here is to try to invest as a credit investor through the overall cycle. Gross leverage on the left-hand side in that fourth line, about 15% in this portfolio. And you won't be shocked when I show you that the trend is very similar to what you saw on the other slides. The difference is I showed 10 years on the other 2 funds. We had to ramp this one up. So we were ramping the portfolio. Then we levered eventually as things started to recover into the pandemic. So you see that up to there. But you can still see we're near some of the lowest levels we've had since the inception of the 6-year history of the overall fund. And so from the opportunity set, we think that there's still opportunities in the credit markets. We think that these structures are very well poised to take advantage of that. But the more important thing is its risk management. We want to be able to have dry powder. We want to be able to go get leverage when we need it. We want to be able to rotate down in quality if something does present itself. But for right now, we're very patient on the opportunity set that we could see there. So, lastly, credit quality been pretty consistent to the life of the fund, but I wanted to show it more in DBL, so I wanted to show it across all four funds. So with that, that's essentially my prepared remarks for today. Let me move over to a couple of questions that I haven't addressed yet. And so someone's asked about income. Fred, send us an email. If you want to ask those questions, send us an email, fun or info@doubleline.com or fundinfo@doubleline.com, and someone will get back to you. Thanks. Someone saying the outlook for private credits and BDCs. Look, I think some of these private credit funds, the semi-liquid structures, they're just going to be under headline risks for the next couple of years, and it's going to be until we get through this kind of cycle of gaining the funds, of the gaining the redemptions. I think you're going to read about this for a few quarters to come. And so until we get through this, the answer is either they need to raise capital or they've got to try to sell some assets to bring it back. At some point, the issue will resolve itself. But we're in the early innings of that. So I expect to read about headline risks there for at least the next year, if not a bit longer. Someone's asking, you can get, I don't know if it's a question or a statement, but it says you can get 6% on recent issue Resi MBS. Yes, you can. So good for you. Yes, all of us can. You are correct. I'm showing index data, so it shows aggregates of parts of the market. So yes, you can get those on BBB RMBS today. In fact, we've been buying them, recently on a spread north of 200, like 210, 215. And then that part of the curve, that gets you something over 6% today. Someone said tips have a real return of 2%. Isn't that pretty good? Do you own any tips in any fund? Yes, we do, but not in the closed-end funds. 2% real doesn't get you enough to hit our income distributions and targets, at least even to try to get to those levels. So yeah, the 2% real return is attractive. We own those in our low duration fund. We own some in our total return fund, a little bit in our core fund, our DB&D ETFs as well, and some of our shorter duration investments as well. So in general, we do like some of that today. Break-evens have collapsed because of some of the news coming out of the Strait, but we'll see how that continues on. Everybody focuses on supply of oil coming out of the Strait. I agree with all of that. The question becomes is when we clear that backlog of tankers out of there, who's got the fortitude to go into the Strait again and what that looks like. So I still think that's a big question mark on the overall market, and those insurance premiums are going to be there as well. Someone's asking about percentages. I've talked about that. And then the last question is, are EM local currency FX allocations managed directly by our team? Are they put through SMAs or local partners that have on-the-ground presence? All investments at DoubleLine are done by DoubleLine professionals. It's our assessment of macroeconomic outlook. It's our outlook for the various fiscal authorities and what's going on with FDI, as well as overall improvements in those countries, as well as our outlook for rate differentials in those countries as well, that help us determine what our FX exposure wants to be across our various funds. So we do all of that investing in-house. We have the experts sitting here, one floor above me right now on the 19th floor, where most of us reside daily. And so from that standpoint, you have about roughly 90 investment professionals that are looking after all the investments here at DoubleLine, including the closed-end funds. So with that, at the top of the hour, I thank everyone for their time today. I thank you for support of DoubleLine, and thank you for your interest in the closed-end fund webcast today. I will have another webcast in about a month where I'll talk. It'll be Sherman says. We'll talk about a couple macro topics, and we'll talk about some questions we're hearing from the field. And if you want to submit any of those ahead of time, use those same email address I talked about, either info@doubleline.com or fundinfo@doubleline.com. Thanks again, everyone.